Kate comes to us with a background in corporate benefits and qualified retirement plans, is a registered securities broker and a registered investment advisor. Next, we have the CEO of Venzer Capital Wealth, affectionately known as BCAP around here. Nick operates his own investment advisory and financial planning firm and is also registered as a securities broker and an investment advisor's representative. Our tax professional this evening is Lee Jameson. Lee's a certified public accountant, a certified exit planning advisor, and a partner at Equity Business and Tax Advisors. Lee's going to share his expertise around year-end tax planning with us this evening. And finally, I'm Drew White. I'm the Director of Implementation at Vita Financial, and I'll be hosting our workshop tonight and fielding some of the questions we receive. Okay, let's get started with you, Nick. Let's talk about income and expenses from a year-end perspective. I'll turn it over to you to do your thing.
Yeah, absolutely. Thank you, Drew, and appreciate the warm introductions. This time of year, we're all gathering for fun holiday meals, families starting to come together, and naturally conversations start to come up around the dinner table. Sometimes it's about projections. Sometimes it's about elections. Sometimes it's about stock market. A lot of financial conversations happen. And so we thought, what better time to have this conversation? This time of year, when we're talking with our financial planning clients, we're really talking to them about how was their income, what's their projected income that we had at the beginning of the year versus what we're seeing as actual income. We also want them to take a little bit of a deeper dive into their budget, their cash flows that we set at the beginning of the year. Now, I want to be very clear. We are entering into the most expensive period for most households. It's okay. We know that October, November, and December are the highest spending months for the holidays and travel, and that's okay. And that's why we like to work in annual numbers. But we want to go and take a look at, based on what the inflows were and based on what the outflows were, how close were we to those projections that we had at the beginning of the year. We also talk with our clients throughout the year about funding emergency funds, having that rainy day pot of gold, as we like to call it. If you've had to use it, maybe AC went out, or your heater, or maybe a tree fell on your fence and you need to get it replaced. We want to make sure those emergency funds get refunded. This is a great time to start looking at that. Of course, retirement cash flows. We'll talk about this a little bit later with Miss Kate, but taking a look and say, okay, how much have I contributed so far? Can I make some additional contributions before the end of the year? How much? That's what Kate's going to go through in a little bit. And then, of course, looking at those goals that you had at the beginning of the year, those short-term, mid-term, as well as the long-term. If you're getting close to retirement, how close are we, right? Is that number coming next year? What have we done to plan? How prepared do you feel? If that number is, 5, 7, a little bit more midterm, farther out, or maybe it's a big purchase that you're looking to make. Maybe you're in your first home and you're looking to go into your forever home. How on track are we to getting those funds set aside and for the furniture, for the down payment, and of course, long term? We always look at what we consider goal-based investing, which we'll talk about a little bit later for our clients, but having those different buckets that you're allocating towards. Are you on track? Are you ahead of the game? Or, hey, are you a little bit behind? And if so, what do you need to do differently for the rest of the year to get you back on track? So these are, big things that we obviously want our clients to review, and we would encourage everybody to do as well, Drew.
Cool. So quick question, Nick. I'm sure it depends on someone's individual situation, but when discussing an emergency fund, what kind of questions do you ask to determine the amount of that fund?
Yeah, it's a good question. So we obviously base it off of their monthly cash flows, and we want to have a minimum of 3 months in reserves. Right. So if I spend $10,000 a month, I want to have at least $30,000 sitting in my emergency fund. Anywhere from 3 to 6 months, I would say, is the max. Anything more than that, that's typically where we have one of our clients that's preparing for a big purchase, and that's totally fine. But if they're not, we want to put those dollars to work in a more efficient and effective way, whether that be investing into the market, paying down debt, or hey, maybe it's making an additional contribution into your 401k for a tax break, or some other strategies that Lee will talk about.
Okay, great. Thank you. Next, let's go to Kate, talk about retirement accounts and contribution limits. These change every year, so there's a lot to keep up with. Kate, I'll turn it over to you.
All right, thanks, Drew. As the year end approaches, it's the perfect time to review your key retirement accounts and ensure they're aligned with your financial goals. You've got your employer sponsor plans, typically a 401k, a 403b, and thrift savings plans. They're excellent vehicles for tax advantage retirement savings. For 2024, the contribution limits are $23,000 and will be changing for 2025 to $23,500. And if you're over 50, you are able to do those catch-up contributions of an additional $7,500. Now, I do want to also mention that starting in 2025, those that age 60, 61, 62, or 63 who participate in a workplace retirement plan can make greater catch-up contributions of up to $11,250 instead of the $7,500. I think they're calling this the super catch-up. But really maximizing your contributions may help reduce your taxable income and build long-term savings. But it's important to balance contributions with your current financial needs. And if your employer offers matching contributions, consider reviewing how to take full advantage of this benefit. It's like leaving money on the table. So if they match at 5%, at least contribute 5%. Now, when we're talking about individual retirement accounts, sometimes this can trip people up, but for IRAs, the contribution limit for 2024 and for 2025 is $7,000, and those over 50 are able to still contribute that $1,000. Now, IRAs offer a lot of flexibility, allowing individuals to choose between tax-deferred growth with a traditional IRA or tax-free growth with a Roth IRA, depending on the eligibility. And with that being said, you can, at year end, consider whether or not you want to do a Roth conversion. Now, the strategy involves transferring funds from a traditional IRA to a Roth IRA. And now, typically, I've seen this done with a 401k if you're able to contribute to a Roth 401k, or even if you're able to contribute after tax and then rolling it right into your IRA. But for this conversion, what we're talking about is making sure that you can time doing those Roth conversions at a time in which your tax bracket is lower. And that's part of that cash flow that Nick was talking about earlier. Now, keep in mind that Roth conversions are taxable events in the year that they occur. So it could impact your overall tax situation. Consult a tax professional and determine whether this strategy aligns with your financial plans. And last but not least, required minimum distributions. Now, for individuals who have reached the age of 73, required minimum distributions are mandatory. Failing to withdraw the required amount by December 31st could result in significant penalties. Some plans have the automatic RMD distribution service, and that's where the service ensures that the account holders who are required to make their required minimum distributions, generally starting at the age of 73, and comply with the IRS rules. We want to make sure that that plan has the automatic distributions, and if not, that we take those funds before the 31st. Also, you just want to make sure that you're calculating and planning for them and really manage the tax liabilities and keep your accounts aligned with your goals. That's what I got for you, Drew.
Great, thank you. So that's great information. One thing that you touched on brings me to a question, and it may sound simple, but how should someone determine how much to contribute to their 401k up to and including potentially maxing it out?
That's a great question. And the answer, of course, is it depends. It depends on your personal circumstances. Here's how different groups might think about it. If you're a younger individual starting early in your career, and if you are contributing the max and you're capable of doing so within your financial means, it allows you to really build and compound on that retirement savings. For mid-career individuals, it's often when you're at your peak earning and your finances are competing for priorities. So you can consider increasing your contributions incrementally. And then for those nearing retirement, if you qualify for the catch-up contributions, it's a key time to focus on building your nest egg. But really what we always say when it comes to contributing to your 401k, if you can't contribute the max amount, at the very least, contribute as much as your employer is matching to collect that benefit. Great question, Drew. Back to you.
Very good. Thanks for that answer, Kate. Let's head back over to Nick. Talk a little bit about year-end portfolio reviews. Nick, can you walk us through what you're looking for when you're reviewing portfolios and some of the questions that you answer for your clients?
Yeah, absolutely, Drew. Just like at the end of the year, when we're reviewing things like your income, your expenses, and your goals, we also want to review your specific portfolios. Now, depending on your investment strategy is going to be really depend on how you want that portfolio balance to be. And of course, your appetite for risk and your time horizon, right? For example, if somebody, like I mentioned, is getting near to retirement, maybe 1 to 2 years away, we want them to be a little bit more conservative than somebody who is 35 and got a pretty long runway until they lift off for retirement. The allocation, we certainly want to look at, but also the balance, right? We've had this thing that just happened. I don't know if you guys were there or not, but there's an election, right? And there was a lot of sweeping changes that we saw in the stock markets and a lot of growth. But there's also a lot of changes that we're going to see in terms of policy in the upcoming year. It's a good time to review with your investment manager or your financial planner, or maybe they're one and the same, and you've got somebody that's comprehensive like us. This is a good time to review that, right? We've had 2 years of tremendous gains. We've seen all-time market highs in the S&P 500, the Russell 2000, you name the index. Maybe it's a time to maybe take some gains. And if it's a taxable account, take some gains off the table and put it into something more conservative. Again, it's going to really be dependent on your appetite for risk. Diversification is critical. We do individual stock portfolios, but we don't have one stock portfolios. And that's because we want to have diversification. We want to mitigate risk. A lot of people think risk management only happens with life insurance and disability income protection, and that's just absolutely false. We here at Vita Financial and Benzer Capital Wealth, we really pride ourselves on risk management on our clients' investment portfolios. How do we do that? We diversify across different sectors and industries that we see as being primed for growth based on market indicators that we follow and track, but also our clients' appetite for risk and their time horizon. So this is a good time to review that with your team and ask questions. This time of year, there's questions that come around the dinner table. Like I mentioned, when you're slicing the turkey, Uncle Leo may ask and be bragging about his new stock, NVIDIA. You're like, oh man, I wonder if that's in my portfolio. Uncle Leo's got it, so that means I need it. So, bring that up to your team. And of course, tax loss harvesting. Now, I just said that this has been a great 2 years in stock performance in the market. So you're probably like, well, why do I have losses in my portfolio? Well, that's because of the diversification. And what tax loss harvesting allows us to do is take advantage of a great run up, but not realize those gains. We can realize losses on some of those losers and reposition and rebalance into some other positions, whether it be individual stock positions, individual bond positions, or even ETFs and mutual funds that are more aligned with the areas and sectors and industries that we see prime for growth in the future. So really, really good time to review all that. Like I said, you know, Uncle Leo, sometimes he's right, sometimes he's wrong. You'll never know unless you ask the question.
Got it. So here's a question for you, Nick. Do you recommend a certain comparison, like a benchmark, when comparing investment accounts to like assess results?
Absolutely. And benchmarks, we all think of benchmarks like the S&P 500, but the S&P 500 isn't a true indication of the stock market. And so make sure that you're utilizing benchmarks like the Russell 2000, or excuse me, the Russell 3000. There's international indexes like the MSCI, and of course, Bloomberg Aggregate. But what benchmark to use is dependent on where you're at in your stage of your financial planning. If you're closer to retirement, you don't want to have a benchmark like the Russell 3000 because it's completely invested into risky equities or risky stocks, right? You want to have something that is more comparative to your portfolio. So we would want to have a blended benchmark that includes some type of fixed income, somebody who's a little bit younger. Again, that would probably be something a little bit more close to having all equities. But again, we don't really want just one single index like the S&P 500 because it doesn't take into account international equities or even those small and mid-cap companies, which have really been outperforming since the election results came in. So, you know, utilize a blended benchmark like a Russell 3000, the Bloomberg Aggregate, the MSCI International EFA Index, as well as the Russell 3000. And what that blend is, you know, talk with your investment team of what makes the most sense for you.
Got it. So the $1 million question is, should I make changes to my portfolio based on the election results?
Man, if I had a nickel for how many times that I've heard this since the election, I'd be, you know, probably sipping Mai Tais on the beach, Drew, but I'm not. It's a great question, right? We are emotional beings and we have these conversations, and the narrative around the election was very intense, I'll say. So it's natural to have that question. Absolutely not. Stick to your long-term investment strategy. There may be opportunities to reposition and reallocate your portfolio, but doing a drastic overhaul is a fool's errand. And we like to say, timing the market is a recipe for disaster. Time in the market with a verified investment strategy is the recipe for success.
Got it. That's good insight. Thank you. Lee, let's move on to you and some tax planning issues that are common at the year-end planning phase. I know a lot of people are going to be paying close attention to this part as there are changes in the tax code frequently. Go ahead, Lee. I'll turn it over to you.
Yeah, thank you, Drew. They had to have somebody talk about everyone's favorite topic, and somehow, since I'm a CPA, they put me in charge. But it's great to be with you guys tonight. First thing I'll talk about is you know, tax season is really right around the corner. And right now, you want to be planning and making sure that you're doing the right things. So one, there's not a huge surprise come tax time. We want to try to avoid any penalties and interest that we may have if we underpay. So right now is a really good time to have a conversation with your accountant and make sure that that you've paid in enough taxes in the right areas, especially if you've had, you know, a significant increase in income this year, or have had other tax changes that could impact this. You know, looking back a couple years ago, the interest on penalties for failure to pay enough taxes was about 3%, and right now that stands at 8%. So you really don't want a loan from the IRS if you owe them tax money at the end of the year. Like I said, typically that occurs when, from what I see, people usually owe penalties when they're a business owner and they have to pay quarterly taxes and they didn't pay quarterly taxes like they should, or it's a high income employee A lot of times I see that they don't withhold enough taxes when your income is high. And it's just something that you need to manually adjust. So now is a great time to review that if you've had significant changes throughout the year. Another thing I'll talk about is stock options. There's a number of different stock options out there, and how they work in terms of a tax standpoint. What I'll say is, I think you should educate yourself, especially if these are new. Educate yourself and have someone educate you on how these work from a tax perspective. Some of them are fairly straightforward. Some of them, like incentive stock options, there's a good bit of tax planning and tax strategies that can go into it with the alternative minimum tax and tax credits that go along with that. So be aware of what you have if you have stock options, because it can there are things that you can do and strategize to lower your overall tax burden throughout the year. Another thing I'll mention is there is a new reporting requirement through FinCEN, and FinCEN is the financial crimes arm of the IRS. They essentially said, we want to know who owns every single LLC in the United States, LLC or corporation. Now, there are exemptions to this, but if you have an LLC that has a small rental property in it, or if you have just any LLC, it may not even have activity right now, but it's still active with the state that you're in, you more than likely need to file this. And so it's due 12/31 of this year. And they are threatening $500 penalties per day for non-compliance. We'll see if they actually go through with those penalties, but they are threatening some big penalties for non-compliance on this. And so keep that in mind. Reach out to your accountants and lawyers, are typically those filing it, or you can potentially file it yourself online. Last thing I'll talk about is, certain states have tax credit programs and things like that. And in Georgia, they've got a number of different programs that you can take advantage of. There's film credits that you can take advantage of that are pretty advantageous. There's also a number of other different credits that are available in Georgia. So different states offer different things. So that's something that you could maybe look at toward the end of the year. There's also other programs where you can redirect your tax dollars to schools, which in the state of Georgia, it's the Georgia Gold program. So there's different programs like that you can think about participating in as well.
Excellent. One thing I thought of to ask you, Lee, was with the election over, as we know, elections have consequences. What are the types of things that we should expect for tax changes in the next administration? I know that you don't have a crystal ball, so there's our disclaimer, but what are your thoughts around that?
Yeah, it'll be interesting to see how everything plays out. I think a lot of the items that were put into place during 2018 with the original Tax Cuts and Jobs Act that Trump put into place, I think a lot of those things, were set to sunset in 2025. I think a lot of those things will continue forward, specifically the QBI deduction, how exemptions and the standard deduction and itemized deductions are handled. I do think we'll see probably an increase in the SALT limit for itemized deductions. Currently, that's at 10,000. There's been a lot of talk about them doubling that to 20,000. It used to not be capped, but back in 2018 that capped, and that really hurt higher income earners and from an itemized deduction standpoint. I don't see it being disadvantageous to anyone. I don't think we're going to have a significant increase in taxes to anyone, whether lower income or higher income. So I think that's overall good news.
Okay, great. Thanks, Lee. Let's head back over to Kate. We're going to talk about family planning, not family planning in the context you're probably thinking, but planning from a financial perspective. Kate, can you give us some insight into what types of vehicles might be available through states and employers that may have an impact on end-of-year family planning?
Absolutely. Family financial planning helps create stability and opportunities for your loved ones, whether it's saving for education, gifting, or protecting your family through insurance, these steps can help build a more secure future. With the school and college savings, you're typically looking at the 529 plans. They are a popular option for education because of their tax advantage. Contributions grow tax deferred, and withdrawals for qualified expenses are tax-free. I know I shouldn't be talking so much about taxes, especially after Lee, but there's a lot to consider. For 2024, you can contribute up to $17,000 per beneficiary, or $34,000 if you're married and filing jointly per beneficiary. And that's without triggering a gift tax. Additionally, the 5-year super funding option allows you to contribute up to $85,000 in 1 year per beneficiary, $170,000 for couples, using 5 years worth of gift tax exclusions. Starting early can help take advantage of compounding growth. Now, when you're thinking about family gifting, it's a powerful way to transfer wealth. For 2024, you can gift up to $17,000 per person tax-free, $34,000 for couples, and this amount doesn't count towards your lifetime estate tax exemption, making it a strategic tool for reducing your taxable estate. So for instance, grandparents might use gifting to fund 529 plans, help with down payment, or even cover other major expenses. It's important to plan gifts within your means and consider the long-term impact. And when we're talking about insurance, it's the cornerstone of family financial security. Whether it's life, disability, or long-term care insurance, these tools help protect your family from financial strain in difficult times. And I'm sure you've heard this scenario before when we're talking about insurance. For example, imagine a family loses their primary breadwinner who didn't have life insurance. Without this protection, their survivors may face selling the home, cutting back on education plans, and struggling to cover daily expenses. Disability insurance is equally important, as long-term illness or injury could create similar challenges. Long-term care insurance is also critical, particularly for the aging community. It helps cover the cost of caregiving and medical expenses, reducing the financial burden on family members. Having adequate insurance ensures your family can maintain their quality of life no matter what life brings. Back to you, Drew.
So that's a lot of saving and a lot of insurance. How do I save for education, a new home, childcare, and retirement all at the same time? What kind of advice do you give your clients on that?
It's a balancing act, and prioritization is key. Start with the essentials. Cover your bills, build an emergency fund. I know Nick talked about emergency savings earlier. You want to make sure you have that built up to handle the unexpected expenses. Focus next on retirement. There are no loans for retirement, so take advantage of your employer matches and save for what you can. Compound growth works in your favor. Now, when it comes to college, saving for college strategically, again, those 529s are tax advantaged accounts, and it allows you to have your kids apply for scholarships or loans, and you can't do the same thing when it comes to your retirement. And then last but not least, I would say automate, set up a direct deposit, set up an automatic transfer from one account to the other. That way you don't see it, you don't know it's gone. The key is progress, not perfection. It's focusing on what's important now and building gradually. Back to you, Drew.
Awesome. Thanks, Kate. Nick, let's head back over to you and touch on year-end planning as it relates to our estate. What kind of events might alert us to a change in needs as it relates to our estate planning?
Yeah, it's a great question, Drew. Unfortunately, I get the morbid topic, but it doesn't have to be morbid. We like to think instead of estate planning being a dull and really sad topic as being peace of mind planning, right? And that's essentially what you're doing. Sometimes life comes at you fast and things don't quite get done as quickly as you wanted them to. And that's okay. But major life events like a death could sneak up on you. It could be even from a family member, an aunt or uncle that you weren't expecting to receive an inheritance. That could actually change the drastic outlook for the rest of your year. If you're getting married, that's a good time to review your wills, power of attorneys, healthcare directives, or get them done together. Also, another big item that we see is if you've moved states, which we have a lot happen these days, right? Whereas a lot of multinational companies, national companies that are growing, you might get asked to go back to their mothership, in Chicago. Well, there's different estate laws here in Atlanta than there are in Chicago, which are different than California. Make sure that you have a legal updated will at your disposal in that new state of domicile. Also, this is a good time to be looking at beneficiaries and looking at your trustees on those wills and trusts that you may have set up. Beneficiaries, this is kind of all intercorrelated, because when we do our financial planning with our clients, we want to really thoroughly go through their beneficiaries. We have their primary set up as somebody, and most of the time with our clients, there's a trust involved, and we want that to be the contingent. Sometimes we have our conversations, and maybe there's a account that fell through the cracks. This is a good time to go back and look through that, especially if you're on our wealth website or our e-money portal. Go through, look through those, make sure that everything's in alignment. If you're not working with our team, you should be. But this is a good time to start having those questions. Trustee updates. This is actually a really, really interesting one that I had a client that came to me that we had been talking. I said, hey, when's the last time we looked at your will? He says, it's probably been about 2 years. I'm like, let's go back through it. We looked through it, and I said, who is this person that you've got listed as your trustee? He said, oh my God, I have no idea why he's on there. I don't even talk to this person anymore. He was the trustee and the guardian for his kids, and his exact words were, I can't stand that person anymore. I said, well, that's kind of a big problem. Guess what? They're going to be in charge of your kids if something happens to you and your wife. So we had to rush and get that done really quickly. Again, relationships change, things change. We want to make sure that you're updating that. And of course, insurance. Again, not to be morbid in any way, but we always want to make sure that we're having our clients with the right amount of coverage. We don't want them to be overinsured. We certainly don't want them to be underinsured. When's the last time that you went through your analysis with your team? It might be a chance to update your life insurance. It might be a chance to update your disability. It could be an addition, or it could even be a subtraction as you're getting closer to retirement. You don't really need that disability benefit like you did before. It's a good time to actually lower some costs. And then I'll also throw in here on the estate planning side, this is a really, really good time to be thinking through, hey, we've had a tremendous run up. We've been doing really, really well. Maybe we should start thinking about trust planning. What type of trust makes the most sense? I'll ask for my good friend Lee's opinion here, because he did talk about the Tax Cuts and Jobs Act, right? Well, we've got an estate tax exclusion that's pretty darn high. Maybe this is a good time to do some trust planning, Lee. What do you think about that?
Yeah, for sure. I mean, we were looking at the estate tax exemption, a few years ago. It was $1 million or $2 million. Now it's up to, I think, 14 or 15 million or so.
Yep.
So if that does ever, if you've got an estate in that ballpark between 2 and 10 million, then at the a vote of Congress, they could change it, and all of a sudden now you've got a taxable estate. So it's definitely something to consider.
Absolutely. We'll end it on a positive note instead of morbid, right? The last decision that you don't want to make on God's beautiful green earth is to pay a big tax bill back to the federal government. I'm sure maybe you do. I mean, then that's your choice. But most of our clients, they tend to say no. So certainly a good time to have those conversations, Drew.
Gotcha. How often, Nick, do you think I should be reviewing my estate plan? What do you think is prudent there?
I would say at a minimum every other year, unless some of those big events happen, right? You know, you get a new job, maybe you're going to work in New York City, or maybe you're going to work for your tech company out in California. It'd be a good time to look at your will. If not, I think every other year is prudent. Again, like I mentioned, relationships change. You never know where life's going to take you. So certainly at least every 2 years.
Excellent. Appreciate that answer, Nick. It's clear there's a lot to be considered around year-end planning. I had some questions for each of you before we wrap up. First one, Lee, is for you. What are some common strategies around charitable contributions to lower my tax liability as the year wraps up?
Yeah, for sure. I'll touch on two different strategies that I see often. One is if you've got a highly appreciated stock, where if you sell that stock, then you're going to have to pay capital gains tax on it. Well, if you've got a highly appreciated stock, then and you're charitably inclined, then you can donate that stock and you get a deduction for the fair market value at the time of donation, and then you avoid the gains tax on it. So that's one strategy. The other is a donor advised fund. So a lot of times I see these when someone has a super high income year, but they're charitably inclined, and so they want to take a big deduction at a really high tax bracket, and then over the next few years they can distribute out those charitable contributions. So it's kind of like you can take a really big deduction now, say you put in a couple $100,000 to it, and then distribute over time, but you get the deduction in your high income year.
Gotcha. Excellent. Thank you. Kate, of course, every person's circumstances are different, but with interest rate changes, do you have any ideas or thoughts around restructuring debt or even using certain kinds of debt to our advantage?
I want to say that when it comes to credit and debt, year end is a great time to review your credit and debt. Check your credit report. It's free, and focus on whether or not there's any errors or any fraud. Now, focus on improving your credit score to secure better loan terms. Part of that is by prioritizing paying down high interest debt using strategies like snowball or avalanche method. It's like having low interest debt, like a mortgage, can be strategic, but carrying high interest credit card balances should be avoided. If you're planning a major purchase or financing next year, you really want to focus on improving your credit readiness now to get better rates and terms.
Awesome. Thanks, Kate. Nick, question for you is about fees. I know this is an opinion, but how do you assess whether or not the fees I'm paying are worth it? What should I be looking for? What should I be looking at to determine if I'm getting value out of what I'm paying for?
Yeah, it's one of the big questions that we get a lot. I think number one, you need to look at the total value that you received from your financial team. Whether they're just doing investments, whether they're just doing insurance, or whether they're comprehensive in doing everything across the board. Number one is think about what's the value that I received back from my team, and did I get more than what I paid for? Or did I get less? If I got less, then hey, why is that? Ask your team that question. I felt like we were going to get X amount, but we got this. A lot of our questions around this tend to stem around investments, right? Again, we track our investment strength against benchmarks and blended benchmarks. So it's a good time to review that. If you've been outperforming, great. Give them a high five in the air and a pat on their back. They've been underperforming, ask them why. Maybe it's because they took a little bit more of a conservative approach coming into the election. That's not a bad thing necessarily. Maybe it's because they missed out on a certain sector. What is their plan to change to get you optimal performance? When it comes to financial planning fees, kind of really where our bread and butter is at Vita Financial and at Benzer Capital Wealth, again, I go back to value, right? Because fees are costs, but not all costs are fees, right? And what's the value that you received back? We've had a lot of conversations about tax mitigation strategies. And if you're working with a good financial team, they're going to loop in a good CPA. They're going to loop in a good investment manager, and you get that full approach. And ultimately, hopefully it's bringing back time for you to go spend what you love doing, whether that's being with your family, maybe it's traveling the world, or hey, maybe it's going and viewing birds in the woods. I don't know. It's whatever you enjoy doing. That's what we want to do, have you do more of, and we want you to be on track for those goals.
Thanks, Nick. Makes a lot of sense. Okay, folks, I think that is going to bring us to a close tonight. I want to thank our panelists. Really appreciate you guys being here and offering your expertise and insight. We appreciate you as clients and potential clients being in attendance. Encourage you to reach out to schedule some time with us if you have any questions or concerns regarding your own year-end planning. And as I said before, if we didn't get to your question tonight, we'll reach out to you directly with an answer. Again, thank you and good night.